Hey everyone, welcome to another video. Once again, it's time to unveil and review my entire portfolio from A to Z. You might have noticed a little drop in my portfolio value from last month's unveiling, and I will of course show you everything and explain why during the portfolio unveil, so don't worry. As usual, I am and will always continue to be an open and honest book to all of you and keep showing you guys my entire portfolio monthly so you could actually follow my personal investing journey. So if you're new to the channel, welcome. The mission of this channel is to help ordinary, regular people invest on their own in order to build their own source of passive income to enhance their quality of life and eventually become financially independent as quickly as possible. But instead of just talking about it, I actually show you how to do it because I've been living the dream since December 2019. So if you're watching this video, number one, make sure you're watching my latest portfolio update video. This video is update number 14 for May 2022. I actually have a YouTube playlist dedicated to all my portfolio unveil videos. So make sure to check out that playlist if you want to see my entire journey, which I share with the whole world. It's very easy to access the playlist. Just click on the name of my channel and then playlist. So if you invest on the Canadian or the American stock markets and you like this type of content and you're thinking about investing on your own already or already doing so, and achieving financial independence is very important to you, please consider subscribing to my channel because my investing style is the best way to achieve financial independence as quickly as possible, in my opinion, the income style. So just a quick couple of reminders about my investing strategy before I reveal everything to you guys. So please listen to this part if you're newer to the channel, as I will cover many of the common questions I usually get. So this should answer most of them. So first of all, I'm Canadian. So the stocks in my tax-free savings account or my TFSA and my non-registered regular cash account are all listed on the TSX, on the Toronto Stock Exchange, the Canadian stock market. But don't exit the video if you're American or you invest on the American stock markets, either the NASDAQ or the New York Stock Exchange, because for my retirement accounts or my RRSP accounts, I invest exclusively in the US stock market. This is simply because as Canadians, there is no additional withholding taxes to pay on the income generated from the RRSP accounts. The RRSP account is the only one that's immune to this because it's a legit retirement account. Lira accounts as well, by the way, because it's also a retirement account. So stick around if you're American, because starting now, or actually the last couple of months, I'll always show my retirement accounts first, so you will see what my favorite US listed funds are for high income. So a quick note about my investing style. I am a long-term, very long-term, if not forever, buy and hold income focused or income oriented investor. So the primary objective of my strategy is really to generate high and consistent passive income via dividends and distributions every single month as safely as possible. So most, if not all, my returns do not come from capital appreciation, although there could be, or stock price increases, that's what it is, but it comes from the income or the passive income that my portfolio generates. So I know this is a hard concept for people to understand because all you ever see and read in the news, in the media, is mostly about growth and stock prices going up and buying low, selling high to make a profit, because basically I never sell anything. But there is another way to make money in the stock market where you don't really care what the stock market does or what stock prices do, my way. So how do I achieve this in a safe manner? Well, my portfolio primarily holds funds, not single stocks. I have no more single stocks, that invest in blue chip, dividend paying companies and that use income enhancing strategies like covered calls or leverage. So they provide fairly consistent income, and the intent is really to hold them, not trade them later on to make a profit, but simply collect the monthly income as you go or the passive income as you go forever, right? So I don't invest in single companies anymore. Who wants the stress and anxiety? Not me. That's for sure. So this strategy enabled my wife and I to become financially independent in our mid-30s back in 2019. You could check out our financial freedom journey video if you want to see our whole journey. And I'm actually planning on making another video on my investing journey where I get a little bit more specific on how I went from just a swing trader to this style of investing. So I'm working on that video. So this strategy might not be fun, it might not be exciting or mainstream, but I could promise you that it works. You just need to stay focused and disciplined, slow and steady wins the rat race. Also keep in mind that I'm not against the mainstream growth strategy where you could just buy the big popular index funds like from Vanguard or iShares, and I am not against the other popular strategy, which is the dividend growth or dividend focused strategy, where you either hold single dividend companies or dividend focused ETFs without the covered calls or the income enhancing strategy. So whether it's income like I do, growth, or dividend growth, they all work long term. Just remember that. So what will I show you in this video? So I will quickly show you my accounts directly in my broker to prove to you that this is 100% legit. And then I will show you my portfolio in Excel spreadsheet, so it's much easier to digest. And we'll go through each fund that I hold one by one. I'll give you my commentary on it, and I'll talk about the changes I made from last month, because there are several this month. So you can also download the spreadsheet that I'm about to show you, the Excel spreadsheet. If ever it's too small and you can't see it, you can download it for free on our website, passiveincomeinvesting.ca. You just need to click on free tools and resources at the top, and it will be the very first download. So you could follow along with me while I show you the Excel sheet. So without further ado, let's check out my entire portfolio together. Let's check out first the broker accounts, and then we'll see the general overview, everything together in those spreadsheets. I just want to take a quick moment to thank my sponsor and partner for the entire month of May, Hamilton ETFs, the experts in the financial sector. A title well deserved because they manage the top performing big Canadian banks ETF in terms of total return and performance, HCAL. They also have a brand new financials ETF, HFIN, which is even more broad in scope and covers the entire Canadian financials landscape. Not to mention, they created two of my favorite ETFs of all time, HYILD and HDIV, which I like to call all-in-one covered call ETF. So make sure to check out their website, as well as the multiple videos I made on some of their funds, including Q&As with the founder of Hamilton ETFs, Rob Wessel. All links in the video description below. All right, everyone. So we will start with the brokers real quick. I'll show you this quickly because it's a lot easier to show you in the spreadsheets, like I keep mentioning every time. So let's start with my personal cash account. So this is my non-registered regular cash account. So as you could see, overall I'm up 10 grand. You know, I think I was in a negative about 3 or 4 days ago, but and you know, if you've been following me for a while, you know that a few months ago I was up like 60 grand. But again, I'm going to keep saying what I always say: I don't care about this because of this simple word, unrealized, right? These are unrealized gain. This only matters if you sell everything. If you don't, which I don't intend to, it literally means nothing. So these are my positions in my my cash account. As you can see, my biggest loser is of course the Bitcoin ETF, as well as the Ether ETFs. I mean, these have gone down dramatically, which you have to expect it. It's crypto. BTCY, ETHY, by the way, is the only way I would ever invest in crypto, because you know, I don't really understand Bitcoin or Ether that much, but I do understand covered calls. So this guy pays me double-digit yield, so I am okay to just hold it forever, and I don't really care what the price does. So yeah, these are my positions in my non-registered cash account. For my TFSA and RRSP, I have moved everything to Questrade. So now my RRSP, my TFSA, same thing for my wife's RSP and TFSA, which I'll show you in a second, as well as a Lira account. So I'll explain that. Basically what happened is I finally got my Air Canada pension plan. I was able to transfer out of Manulife into a Lira account. So that's what this new account is. So I do have an RSP, TFSA, and now I do have a Lira account with one holding, and I'll show you what I have. So this is just to show you guys, show everyone that, you know, what I'm telling you is legit. I won't go into detail on the RSP and the TFSA account, because what happened is there's no point, basically, because once I did all the transfers from TD to Questrade for the RSP and TFSA, whatever you transfer, let's say I'm up $5,000 or have unrealized capital gain of $5,000 in something in my RSP or TFSA in my TD, when you transfer it, it's like it resets to zero, basically. So there's really no point of showing you all my holdings here. I just wanted to give you the overview. So now let's check out my wife's cash account and her TFSA and RRSP Questrade account as well. All right, so this is Erica's non-registered cash account. Only 4 positions left here. Still in the positive, but again, I don't really care. So yeah, you might be wondering, well, where did everything else go? Well, a lot of it had to be sold off. A lot of single stocks that I had left were in Erica's cash account. So those were all sold off due to my Panama move. So if you've seen my Panama videos, you'll understand why. I'm not going to get into it here. But again, I'll show it to you in Excel in a little while. So this is my wife's cash account, just 4 positions left here. And as well, her TFSA and RRSP was also moved to Questrade. So you see that here. And once again, I won't go into details to show you the positions in there because I'll show you all that in the Excel file. So if you add up all the totals, the total account values for all 6 of these accounts, well, I'll make it 7 now with my Lira, it's just over $1 million of value. So it's actually, when I have it here in front of me, $1,015,000. So now let's check out the Excel file, the spreadsheet, which again, you could download yourself on my website, and we'll see the whole breakdown, and it'll be much cleaner and easier to see. So let's get going. All right, so as usual, we will start with the retirement accounts, the RRSP accounts, where we invest on the US stock market. So I'm doing this first for my American friends so you guys could see what US listed funds I have. So my RRSP here, you'll see a little bit of changes. There's one slight change that I made from last Unveiled, and I actually have or created an RRSP tracker, just like my main portfolio tracker, because I know you guys appreciate it, where you can actually see everything I do every month. So basically, in May this month, I sold off RA, my Brookfield Real Assets Income Fund, in my RRSP, and the reason was not because I don't like it. I absolutely love RA, but it's simply, basically what I did with QYLD and RYLD. I also sold those off because QYLD, RYLD, and RA, which is the one I'm talking about, are already big positions in my wife's RRSP. So I felt like I don't need duplicate positions. So I simply sold off RA. What I was actually at a little profit, and with the proceeds, this is what I bought. I invested another $6,000 in CLM, which I caught at a good time when it went down after the offering. I think I got it at $10 or something like that. So I added a little bit to my CLM position. I added 10K to CEFD, one of the rising stars in my portfolio, which is an ETN from eTracks, which tracks all the closed-end funds. So this is kind of like buying all the closed-end funds on the US stock market with 50% leverage. I really like it. I'll show it to you in a second, and I'll talk about it in a second. I also added 5K to OPP. So OPP has been suffering because it has a lot of fixed income, a lot of mortgage-backed securities, which hasn't been doing well, but it's starting probably to turn around, and the fund is trading at a 9 or 10% discount. So I just, I'm an opportunistic investor. So I put another 5K in OPP, and I added another 5K to SVOL, another rising star in my RRSP, which I just did a video on. Really cool fund. So in summary, my RRSP has 9 positions right now. And by the way, I added this here. Basically, if you have an account where you're not taking any of the income out, so either you're dripping it or you're manually reinvesting the income, which is what I do for my RRSP, and my wife's RRSP is on drip. The easiest way to really know how you're doing is how much did you contribute and what's the value of your portfolio, right? So lifetime RRSP contributions, 139,000. Right now, my portfolio value, like I showed you in my Questrade, it's about 191,000 Canadian. So right now I have an overall return of 37.41%. So this is just tracking how much I actually put in of my own money and how much the portfolio is worth. That's pretty much, in my opinion, of course, all you really need to track to know how an account is doing if you are dripping or reinvesting the income, if you're not extracting any of the income. And for our RRSP accounts and my Lira account, we are not extracting anything. It's just being reinvested, either manually or with a drip. All right, so now that's out of the way. Let's go through the positions one by one. So I have CLM at 30K, which, they did a rights offering, the price tanked. They suspended the rights offering, the price spiked up. Now they're redoing their offering, they announced, and the price went down a little. I think right now, CLM, the NAV is about $7.50 and the stock price is about $11 or high tens. I would not buy more CLM right now. I think it's the premium is just too big, right? The closed-end fund premium. What I mean by premium is that the NAV, the stock price is way higher than the actual NAV or the value the value of the fund. So I wouldn't pick up CLM right now, not at this level, but if it goes under $10, maybe it'll get more interesting. So 30K in CLM, a big position here, making a really sweet 18.67% yield. Keep in mind that this yield or the dividend is reset annually, and from the current NAV, the dividend is going to be cut tremendously for 2023. But you never know, time will tell. Time will tell. But even if it does get cut, it doesn't make a difference to me. It's still a very, very nice yield, and I don't intend to sell it anyway. OPP, like I mentioned, I added another 5K in it. So I have, it's also another big position here in my RRSP at 30,000. It's honestly a great time to pick up some OPP. It's trading at a discount right now, an 8, 9, or 10% discount, which is the opposite of CLM, right? So it means that the NAV price is actually higher than the stock price. So you're automatically getting a good deal. SVOL, I made a video on this. I interviewed the fund manager. Really, really unique and interesting ETF. I have a feeling there's going to be more and more of these options-based strategy ETFs coming out. SVOL is one of the simplest ones to understand, and really, really high yield, which the fund manager estimates is always going to be over 15%. And he's actually right. I'm actually making 16.84%. Of course, the annual dividend is hard to calculate because the monthly dividends change. So this is simply an estimate. It's up to you what you want to put as an annual dividend. The easiest way is add up all the monthly distributions divided by the number of monthly distributions, and that will give you your basically the average monthly distribution or dividend, and you just times that by 12 to get the annual. So that's what I did. It's about $4 a year. CEFD, I absolutely love this ETN that I discovered. It's the eTrax monthly pay 1.5 leverage CEF index. So this ETN, it literally tracks an index that holds all the closed-end funds in the US market. Not all of them, but most of them. So basically, I think of this like an all-in-one closed-end fund solution, and it has 50% leverage. So the yield is very, very high. It's always about, between 12 and 15. I'm making 14 on it, so I really can't complain. Really, really like it. I think it's safe. Yes, it has a lot of leverage, but I think it's safe because it's, I kind of compare it to what HYLD does for the covered call. So HYLD, HDIV, HDIF, kind of like an all-in-one covered call solution. This would be an all-in-one closed-end fund solution on the U.S. stock market. A little similar to what RIV does, which I'll get explained in a second. HGLB, a little closed-end fund that is always trading at a discount. I don't know why. It never gets any love. I haven't added to it yet, but this is always a good one to have, especially when it's trading at such a big discount. I think the discount is over 20%, which is like basically buying something at 20% off. Absolutely incredible. I have a nice yield. The NAV is reset annually to 8.5%. Sorry, the dividend is reset annually to 8.5% of the NAV. So very, very similar to what CLM does, except CLM is 21%. So this is a very, very conservative dividend basically. So right now the NAV is actually a lot higher than the stock price. So if it actually gets reset at this level, my dividend is actually set to increase again in 2023. So I'm super happy about this one. A nice little fund, niche fund, and I'm gonna just leave it here. ORC. So ORC is I get complaints about it all the time. ORC is just leveraged mortgage REIT. So it's very specific. It's very niche to mortgage REITs, which is why it hasn't been doing well. But the tide does seem to be turning on ORC, guys. I'm sure if you own it, you notice that it's starting to crawl back up there. So, ORC is something that I still feel very comfortable owning, even though it's down. I'm down significantly on it. I think it just actually passed $3. I'm at $4.97 on it. That's my book price. But why am I comfortable? Because it pays me every month. It has to pay you every month because it's technically a REIT. So yes, it reduced the dividend a couple of times, but they announced the last couple of dividends have stayed firm at 4.5 cents or 54 cents annually. So hey, over 10% yield, I'm still not going to complain, and I have a feeling that if we're patient enough, they might raise the dividend, re-raise it eventually, so this yield will go up. But this is something I don't intend to touch or ever sell until I break even on it. Then we'll see. There's a cool option from the same guys who make CEFD. They have an ETN that has all the mortgage REIT companies in the US, including ORC. So ORC is one of the holdings in that ETN. So maybe I'll swap ORC for that one. Not sure, we'll see. The next two are my other ETNs, my commodity ETNs from Credit Suisse. I don't intend to add any more of these, even though they're very, very high dividend payers, especially the oil one, USOI. I mean, look at this yield, 41% yield. That's not a joke. That is serious, but these are very, very, very niche. So I always keep saying it, but if something is niche, don't put too much into it. Make the more generalized funds that have a lot more stuff in it. Things like CEFD, CLM should be a little bit more primary, because they're more diversified. So this one's silver, this one is oil, and then last but not least, you have the Purpose Ether Yield Fund. So this is actually listed on the Canadian stock market. So I know I say, I invest only on the US stock market. That's technically not true for the RRSP. This fund is a Canadian listed fund because there's no US equivalent, but it's the .U version. So I get it in US dollars. So if ever you're American and you're interested in investing in Bitcoin or Ether and you want income, you could invest in ETHY BTCY.U. You got to go for that .U so you get it in US currency. A very, very high yield, always double digit yield. So so overall, I'm actually making a little under 17% yield in my RRSP. Keep in mind, guys, my RRSP, I consider it my YOLO account, my you only live once account. I go a lot heavier on the risk. I go for a lot more niche funds because it's a long-term account that I don't intend to ever touch for probably decades. So this is why I go higher risk here. So I know a lot of people copy my portfolio, so just be careful with that. Keep in mind that my RSP is a little bit more higher risk. This is where I really have my fun. My wife's RSP account is a little bit more conservative. Yes, it's full income, but it's more conservative. So in there, you have the same 5 positions. It's on DRIP, QYLD, RYLD, which are probably my 2 favorite covered call ETFs on the US stock market, both of which have gone down. RA for the real assets. I love this fund. This takes care of all my real assets exposure. So real assets is real estate, it's infrastructure, it's natural resources. Brookfield, I trust them. They are real assets. Experts, it's actually a Canadian company, but this is, in my opinion, their best fund, and it's on the US stock market. River North Opportunities Fund, I really like it. It's kind of like an all-in-one closed-end fund solution. So it's a closed-end fund that holds a bunch of other closed-end funds on the US market, and it has a lot of about 30% in SPACs. So pretty cool. A dividend policy is kind of like CLM and what HGLB does, and OPP. It resets annually, but this one is 12.5% of NAV, just like OPP. It's managed by the same people. So really, really cool fund. And GOF is purely fixed income. It's one of the best fixed income style funds on the US stock market. Always has been returning over 10% annual return since inception. Really, really cool. So you have stuff in here like high yield corporate bonds, bank loans. There is a little bit of equity, but not much. It's mostly fixed income. So yeah, pretty cool. And yeah, I messed this up here. Let me just hit undo. Perfect. So so my wife's account, RSP account, is on DRIP. So this is why I'm very happy when I see QYLD, RYLD, and I see the market go down and these funds go down. Now you might be thinking, well, this guy's crazy. No, it's because if you're dripping an account, guys, think about this. If you are dripping an account long-term, you want the stock market and the stock prices to go down, because once your drip goes through, you are buying cheaper units. So the fact that QYLD and RYLD, which are the 2 biggest positions, are significantly down, well, not significantly, more QYLD because it's a NASDAQ. The NASDAQ has been going down. It makes me happy because when my drip goes through, I will get cheap units here in this account. So I don't have the yield calculated and do much tracking for this account because it's on drip. That's basically why, but I estimate the yield's about 12% on this account. And last but not least, I got a Lira account because I finally got my Air Canada pension that I've been contributing. So I finally got it out of Manulife and got it into a Lira. It took a lot of time and paperwork, but it's finally done. So total contribution was 33,000, and keep in mind that half of this 33,000 was given to me by Air Canada because they matched it basically. So out of the 33, I only put in half. So for this account, Lira account, I said I'm going to go full YOLO. I, it's like the RSP. It's a long-term thing. So I decided I want to get one thing. So what did I get? I got the Bitcoin yield ETF, BTCY. I put it all in there. Of course, I'm down on it significantly. I'm down 24%. So right now the account's worth 25,000. I put in 33,000, but that makes me happy, guys. You know why? Also because it's on drip. So when my drip goes through, which is a pretty big drip, right? I got 49, almost 5,000 shares. So when the drip goes through, I'm going to get $377 worth of much, much cheaper shares. So the compound interest effect is much higher. So yeah, and this is on the Canadian stock market. I know I say, RSPs in the US stock market. So I just left it Canadian. I didn't want to convert it. So I just invested in BTCY. So I'm making $377 just off this. So together, if you calculate how much my RSPs are making monthly, it's 3730 US, 377 Canadian. Add that up, do the conversion. It's a little over $5,000 a month that our 3 retirement accounts combined are compounding every single month. And we don't intend to touch this for at least 10, 15, 20 years anyway. So we're going to go a little bit more risky here. So this is the RSPs in a nutshell, everyone. Now let's check out what I call my main portfolio, which is a combination of our TFSA accounts and our non-registered cash accounts. All right, TFSA and cash accounts. So this is our 2 TFSA accounts, our 2 cash accounts together, put in a spreadsheet. And again, you could download the file on my website if you want to follow along. And keep in mind that when you download the Excel file, I've been getting concerns and questions. They say, hey, I only see the RSP, I only see this. Well, guys, there's tabs at the bottom of the Excel file right here that you have to switch between, right? So let's go through it. First, let's go through the changes, because as you could see, it's much, much smaller than last portfolio unveil. So let's check out the main portfolio tracker and see the changes that I did in May. So I'm talking about this year. Let me just hide the 2021 one. So like I talked about in my Panama video, my latest Panama video, because we're moving to Panama, we need to unlock money or cash for the visa process. We have to invest 200,000 US dollars into the country to apply for the Friendly Nations visa. So I had to sell off some stuff. So I sold off in May the remainder of all my single stocks and REITs. So DE, which is decisive dividend, EIF, exchange income, Slate Office REIT, Firm Capital. So all those I sold off. It was my intention to probably sell off all my single stocks anyway. So I took this opportunity because I needed the money anyway. So I sold them all off. I was up on all of them. So it was a good time to do it anyway. So besides those, and yeah, and like I say here, all sales in May due to Panama move, not because I wanted to. I wanted to make sure you guys understand that, I am a buy and hold investor. This is just a special, rare circumstance because I had to unlock some money. But my intention when I invest in something is always to buy and hold it forever. So on top of the single stocks that I sold, I did have to sell a little bit more to get more money. So I trimmed down basically things that I was up on mostly. So I trimmed down Inc.UN, $10,000 off that. I did get rid of ftn.pr.a. I had purchased it last month just to park some money, because I had also started selling some stuff. So I knew this Panama thing was coming up. So I said, you know what, instead of just leaving it in the bank account, let me put it in ftn.pr.a. At least I'll make a couple of $100 of dividends on it. So I got rid of that too. And I trimmed down a little bit Financial 15 and LBS, 2 split funds that I like. I trimmed them down by $5,000 each, just a little bit. So these are the changes that I made in May. And that would equate to this portfolio that I have now. This is now a lean, mean income machine. So I have no more single stocks, everyone. These are all funds. Let's go through them one by one. I have 3 closed-end funds on the Canadian market. EIT, which is the Canoe Financial, from Canoe Financial. In my opinion, the best closed-end fund on the Canadian stock market. These guys are stock pickers. They typically pick dividend growth companies. These are all big cap blue chip companies, and they're actually beating the overall Canadian market. Very hard for an active manager to do. So Canoe Financial is doing it. So this is very, it is a bit more Canadian focused. So you have a lot of financials, a lot of energy in here. And this is why this fund has been doing particularly well. And as you could see from my overall position, this makes up almost 9% of my portfolio. So of course, if there's a big position, big percentage, I like the fund. So this is what I consider one of the big 6. right now. I'll go over the big six in a second. So this is definitely one of the big six. I'll just highlight it here. DS Inc.UN are the non-split funds from Quadravest, primarily a split fund manager. So these are just regular closed-end funds. They don't have the split share structure, and the way they're designed is that the dividends vary every single month, and they vary based on the stock price. So they always target 10% of the stock price. So I'm doing very, very well on them because I bought them very cheaply back in 2020. I have extremely high yields on them. So DS is basically the twin brother of DFN, which is the biggest and most popular split fund in Canada. You can actually see they have the same name. So you have the best 15 of the best Canadian dividend growth stocks in there. The six banks, Bell, TELUS, Enbridge, Manulife, Sun Life, etc. So really, really good quality. It's still trading at a little premium. This fund, it's trading at maybe a 10 or 11% premium, but I think it's a good pickup if ever you want some Canadian exposure and you don't, some high yield Canadian exposure, but you don't want the risk of DFN or DGS because they're split funds. DS is a good alternative, but of course you're not going to get as much yield. You'll always get about 10% on the stock price here. Inc.UN, very similar to DS in terms of dividend policy, except it's all financial stocks. So I trimmed it down, like I mentioned before, 10,000. So I have a very, very, very small position here. I hated to trim this one down because I was making such a big yield on it. But I had no choice because of the Panama move. I needed to unlock some money. ETFs, I am down to only 5 ETFs. And in my opinion, these are really the only 5 you kind of need. So the first 3 are also part of what I call the big six. These are the all-in-one covered call solutions, 2 from Hamilton, 1 from Harvest. Probably my 3 most favorite funds in the world right now. It makes our job so much easier. It's literally an ETF that holds other covered call ETFs with 25% leverage. They put 25% leverage. I got videos on all of them separately. You could check them out, but if you scroll on the comment here, I actually write what 7 ETFs are inside HYLD, which 7 are inside HDIV, and which 5 are inside HDIV. So really, really cool, all in one. These are by far the best things you could probably get right now because they have the characteristics of a split fund. So high yield, covered calls, leverage, without the structure or the risk of missing dividends like a split fund. So really, really cool. They're kind of like split funds 2.0, split funds without the risk. So really, really awesome funds here. HYLD is definitely the one that's undervalued, definitely the one that's has good value right now because it's very US focused, it's very tech focused. It has QYLD inside of it. It has TXF, which is only a technology covered call ETF inside of it. So a lot of tech, amazing yield, almost I think close to 11% or so. And I was very surprised that they actually raised their dividend a little bit. I didn't expect it. Awesome. I absolutely love these 2 Hamilton ETFs. HDIV, a little bit more Canadian focused. So you have this, you could tell right away by looking at what's inside. So you have the ZWB, which is the big 6 Canadian banks, ZWU, which is utilities, NXF for your oil. So it's a little bit more Canadian focused. But I love how they throw in the HHL and the HTA. So you also get that healthcare and the technology, which is basically non-existent in the Canadian market. So the way I like to look at it is, let me just cover HDIV. HDIV is Harvest's all-in-one covered call solution, and it's special because it only has the 5 Harvest covered call ETFs, and because of this, there is no management fee with this ETF. So that's very interesting. So yes, the Hamilton ones have a 0.65% management fee on top of the funds that have their own management fees, but HDIV doesn't because they're all Hamilton products. And by the way, I keep forgetting to mention, if you unhide here, I actually put the management fees for each fund. As you could see, HDIV is 0, and when they were created. So if ever you're interested, you could unhide those columns. So these 3 amazing all-in-one covered call solutions. So what you could do, and this is the way I look at it, HYLD and HDIV a little bit more US focused, and EIT and HDIV a little bit more Canadian focused. So that's how I look at it. Then, of course, I got my 2 covered called crypto ETFs, 1 for Bitcoin, 1 for Ether. Both have been taking a tremendous beating. They are pretty much, I've read, 77% correlated to what the NASDAQ does, and the NASDAQ's been taking a beating. So they pretty much act kind of like growth tech stocks almost. So I'm down on, I'm down on them. The Bitcoin one, I will not be adding anymore because I already bought the Bitcoin one in my Lira account and it's dripping. That's the key. So I know I'm going to be buying or getting Bitcoin every month. So I feel like I do not need to buy more BTCY. And, together they make up now almost 10%. So I don't want to go over 10% in crypto in my main portfolio. So Bitcoin I won't be buying anymore. ETHY I probably won't be buying anymore either. Keep in mind ETHY, I do have a little bit of it in my RRSP account as well. And I might be adding some here because now it's like 25, 26% yield. It's absolutely incredible, very, very tempting. So although I'm not adding any in this portfolio here, my TFSAs in cash, I think right now there's no better time to actually pick up some crypto if you guys are interested. But keep in mind, it's niche, okay? It's higher risk. So just go easy on it. Most of your money should go, like I said, in the more broad funds like the big six. All right, so those are the ETFs. Now let's go through the split funds. DFN is the biggest split fund in Canada. It's over, I think it's actually just under $2 billion of assets. So it has the best 15 Canadian dividends growth stocks, very, very solid yield. Usually it's typically, 13, 14, 15% yield. It only missed 4 dividends ever, all in 2020. And this fund was created in 2004. So yeah, and by the way, if you scroll on my comment here, you could see. So they only missed 4 dividends out of 216. So relatively low risk to miss dividends. Really a good high yielding fund for Canadian growth stocks. So basically the 6 banks and Manulife, Sun Life, etc., Enbridge, Bell, Telus, etc. FTN is just financial stocks. So Financial 15, also from Quadravest. So it's about 60% Canada, 40% US. Exposure here. So you have the 15 best financial stocks or the biggest ones in North America. The big banks again, the 5 biggest banks in the US and the life insurance companies in Canada. So I trimmed it a little bit. I'm at 20K now. And this one has missed some dividends and missed 34 dividends out of 219. But they did do a reverse split or a bad split back in December 2020. And so basically right now, the unit NAV is like $18. So it's a lot more conservative than it used to be because, or think of this one like the conservative version of FFN. It's pretty much the same 15 companies as FFN. And I know FFN has been getting a lot of attention lately because it went under $15 unit NAV. And as we know, there's no dividend for the Class A shares if the unit NAV is under $15. So I've been getting a lot of questions. Should I sell FFN? Should I just keep it? Should I just hold on to it? Everyone has to make their own decision, guys, when it comes to this stuff. What I could tell you is missing dividends once in a while is not really a big deal. Okay, so think of this like a nice experience, a good first experience that you're missing dividends. The question you should be asking yourself is, can you afford to miss a couple of dividends once in a while? Can I afford to do that? Because you're basically trading that risk for much higher yield when you do get the dividend, right? So FFN, if you're investing in it right now and you're basically getting like 21% yield, although you're not getting the yield yet. But if you're buying FFN now, for example, and the unit NAV goes over $15, if financial companies start taking off again and FFN goes over $15 unit NAV, you're essentially getting whatever yield you booked it at, 20% yield. So it's all about risk reward trade-off, guys. Keep that in mind. Personally, I would not sell FFN especially if you have it at a loss. Why would you sell it at a loss? Just wait it out. That's the best thing. And if you want something, if you like the high yield, you want something a little bit more conservative, similar to FFN, well, FTN would be it. Now the Brompton ones, really like the Brompton ones. LBS, which is just the big 6 Canadian banks and the 4 life goals. It's done very, very, very well. This one also, the unit NAV is pretty much neck and neck with FTN. The only difference is it's all Canadian. It has no US exposure. So I also liked LBS a lot, kind of like a medium. So FTN, LBS, even DFN, I would consider them kind of medium risk, and I'm actually working on a split fund risk rating system for the new version of my package. I think you guys are really going to like it. But LBS did miss dividends also, 18 out of 185. So it'll give you an idea of what you could expect. But basically, it's all financial. So it only misses dividends basically when financials take a big beating. SBC is my favorite split fund when it comes to only the 6 big Canadian banks. There's SBC, there's BK from Quadrivest, which is a higher yielding option. It tries to always tries to get 15% yield. SBK is a little bit more conservative on the yield. But if you actually compare BK to SBC in terms of annual compound returns since inception, SBC destroys BK. So just because you're getting more yield, guys, doesn't mean you're getting more total return. Never forget that. So it's up to you on what you want. So I went with BK. I'm sticking with it. They missed dividends, only 4 back in 2008. They actually did not miss any dividends in 2020 during the COVID crash, which is, tells you a lot. So this is what I consider a low risk split fund. So and the reason why these colors are green and this is orange is because orange is if I personally missed any dividends, and green is if I never missed any dividends on these funds, by the way. And I have the stats for each one. You could, when you download the sheet, you could check it out. GDV is one of the 6 golden funds. It's my favorite split fund of all time because it's amazingly diversified. You have regional diversification, you have sector diversification. The name says it all. 45 global dividend growth split fund. And basically what it has is about 45 to 50 of the best global blue chip dividend growth stocks. So you have Europe, you have North America, you have all sectors, really, really well balanced, has never ever missed a dividend since June 2018 when this fund was created. I consider this a low risk split fund as well with a very, very nice yield of about 10-11%. So definitely one of my big 6. Okay, DGS is DFN's main competitor. So DGS is actually the second biggest split fund in Canada. And just like DFN, it focuses only on the best Canadian dividend growth stocks, except it has pretty much double the stocks. So where DFN is a little bit more concentrated in the banks and the life insurance companies, DGS is a little bit more broad. So it has double the amount of stocks. But both are very similar in terms of annual compound return since inception. They're both over 10%. But DGS has higher yield, which will mean a little bit more of a chance of dividend misses. So DGS missed 24 out of 172. DFN missed only 4 out of 216, but they both have similar total returns, which is very, very interesting. So very cool options. So the way I look at it is DFN and DGS is my higher risk way of getting a high yield from the best Canadian stocks. And together I have, 30,000 and 20,000. So that makes 50. And my DS is kind of like my middleman, my plan B or my just in case, because DS has the same stocks, but never misses dividends. But the yield is of course lower. It always targets 10%. So that's the way I look at it. PWI, very interesting. It's basically the first ESG split fund. So it focuses on sustainable power, infrastructure stocks, utilities, green energy. It has real assets. So pretty defensive sectors. So the yield or the reward is going to be lower, right? Don't forget, lower risk, more safety equals lower yield typically. So that, it is my lowest yielding split fund. But in my opinion, one of the best ways I found to actually get some decent yield off of green energy companies. But keep in mind, it's not just green energy. It has other stuff in there as well, like Bell, like TELUS, other infrastructure stuff. ENS I absolutely love. It's my favorite way to get Enbridge exposure. It's the only split fund that I own that only has one company, Enbridge. But it's I can't think of a better company to make a split fund with. I talk about this with the Middlefield guys in a recent Q&A video I did. Make sure to check it out. Rob Lozon manages Enbridge. He's a utilities expert. So really, really good yield here. It's a way to get maximum yield or leverage exposure off of Enbridge. That's basically it. I have 30K, nice 5% position here, but it is niche. It is only one company. So make sure you keep that in mind, but also very, very, very low risk split fund. The unit NAV is like $26 or something. It's actually the highest unit NAV split fund right now. And RS is the other one that they have. This is the sixth of my big six funds, or my favorite funds, and you could actually see by the big position here. So this is where I get my real estate exposure. RS is kind of like an all-in-one solution for big blue chip Canadian REITs. So you have Smart Centers, you have RioCan, Crombie, Northwest Healthcare, Allied Property REIT, Granite REIT, 15 or 16 or 17 or something like that of the best REITs in Canada. So why own REITs individually when you could just own RS? That's what I say, and you'll get a nice over 9% yield here. So really, really my go-to when it comes to Canadian real estate. So totals now, all in all, I'm still making, with all the sales, I had to sell a lot of stuff. So I went from, I think, 7,000 something a month to 5,850 a month, which is not so bad at all. Making still a dividend yield or a distribution yield overall of over 11%. This is just the amount of money I put in. So if you actually add the principal I put in for the TFSA and cash accounts, the principal I put in for all the RRSPs, which we this number, the total is actually a little over 900,000. And if you actually calculate the value of all the portfolios, like I showed you at the beginning, it's a little over $1 million. So overall, I am still up. Not that it matters, or not that I care anyway, because I'm a buy and hold investor. So yeah, here you have the breakdown as well. So what percentage of my portfolio is closed-end funds, which percentage is ETFs, how much percentage is split funds. You might be thinking, well, split funds is very, very, very high. You're right, but keep in mind that the majority of my split funds are low-risk split funds, okay? Just because you see split funds doesn't mean high risk. There's a very broad scope of risk when it comes to split funds. For example, ones that I consider very, very, very safe, like RS and ENS, SBC, GDV, even PWI. You could even throw DFN in there. So if you add up the exposure there, it's 38%. So 38% out of 47 are with the safer split funds, in my opinion. The ones that are a little bit more risky, or is maybe DGS, FTN, LBS. And when I say risk, guys, I just want to make sure this is clear. Risk pertains not to the stock quality inside these split funds. They're all great stocks, blue chip stocks. The risk I'm talking about is risk of missing dividends. So it's up to you to analyze that and think about, can you afford to miss dividends? So that's really the $1 million question. If you can't, if you're not comfortable with it, do not get the split funds, or you could only stick with the lower risk split funds and just stick with the all-in-one covered call solutions. But in my opinion, GDV, RS are pretty much my favorite split funds of all time here, and part of the big six, or what I call my big six. So there is the portfolio from A to Z. I'm exhausted. My throat is dry. I hope you didn't fall asleep. So there you have it, guys. My whole entire portfolio from A to Z. Thanks for watching, everyone. Really appreciate it. Please show your appreciation by hitting that like button. It's free for you. It takes 2 seconds. It helps the channel grow. It helps get the message out. So it's a win-win. Also, if you like this type of content and you're not subscribed yet, make sure you subscribe. Hit that little bell button so you're notified of any upcoming videos. You don't want to miss them. And make sure to check out our website, passiveincomeinvesting.ca. That is where you could access a bunch of free tools and resources. You could download my portfolio, my monthly stock pick report card as well. And of course, that is where I offer my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. You only have to buy it once. It comes with lifetime updates. My plan is to do an update at least annually. So version 4 is scheduled to be released in Q3 of 2022. So stay tuned. It's going to be a really, really cool update. So this product is really to help you build your own portfolio, no matter what your investing goals are. So it's not just tailored for income investors, but there's also sample portfolios, for example, for growth, for dividend growth, and income as well. So it's a really, really cool product. It's really designed to save you time on research, of all the crazy great funds there are out there. There's so many of them, so many ETFs out there. So this product will help you think of it kind of like a reference tool or reference guide to help you build your own portfolio. I also offer a one-on-one coaching session. It's right there on the homepage if ever you need more personal one-on-one touch where you could ask me all the questions you want and I could assist you best I can. Keep in mind though, this is not a financial advice or financial planning session because I am not a certified or a registered financial planner. This is just a regular lifestyle coaching session where you could ask me all the questions you want and I give you my opinion based on personal experience. Also, we have a Facebook page, over 11,000 members now. We are very, very strict about letting people in. We try to get rid of the scammers and bots right away. So it's a very, very cool group where everyone is sharing their experiences, asking questions. So make sure to join us there. Passive Income Investing is the Facebook group name. We're also on Instagram. We don't use it much, but we plan on putting more personalized stuff on Instagram. So make sure you follow us if you want a little bit more personal stuff on our everyday life. So once again, the mission of this channel, well, my mission will always be the same. It's to help ordinary, regular, working people invest on their own. Do-it-yourself investing in order to build your own stream of passive income, to enhance your quality of life and become financially independent, to become financially free. So as usual, stay safe, stay healthy, and of course, stay passive. See you next time.